In this video, I'll go through Work Together problem 12-2 on page 349 of your Century 21 Accounting Textbook, Advanced Edition 11. This is by Gilbertson Lehman, so we'll give them credit where credit's due. All right, so we are journalizing bond interest payments now. Okay, so on June 30th, we paid cash to a trustee for the semi-annual interest payment on a $300,000 6% bond issue having a carrying value of $296,190.63 and a 6.3% effective interest rate. Check number 654. So the check number is pretty easy, right? 654. But then, how much is our interest expense? We've got these two different rates, right? We've got what the bond was issued at, the 6.0%, and then the effective interest rate today, the 6.3%. So because the interest rate is, the effective rate is higher than what the bonds were issued at, we had to give them a discount so they would buy them, right? Because who wants 6% interest if you can get 6.3% somewhere else? Okay. So there'll be a discount on this one. How do we calculate the interest expense? Well, first, we've got to do the carrying value of the bonds. So that would be, why isn't this working? Equals $296,190.63. And then we'll take that times our effective interest rate, so 6.3%. And then we'll take that times the portion of a year, or the time. So it's a half a year, so we'll just go 1/2, get it done 0.5. And that gets you to $9,330 interest expense, okay? But cash credit, that's not the amount. It's going to be the face value, which was $300,000, times the stated interest rate this time, so the 6%, and then it's going to be times, your time is a fraction of a year, half a year, 0.5, and then that's your interest payment. So you're actually paying $9,000. The expense is $9,330. So then there's going to be a discount on bonds payable here, right, of the difference, $330. But we'll just go ahead and use a formula anyways. All right. So that one looks good. How about the next one? We pay cash to a trustee for the semi-annual interest payment on a $500,000 6.5% bond issue having a carrying value of $506,365.13 and a 6.2% effective interest rate. So this is the opposite of the previous one, right? Last time the effective interest rate was higher. This time it's 0.3% lower. So it's going to be the opposite. We're going to have interest expense, and then we're going to have this premium on bonds payable, because our bonds pay a higher percentage than what the interest rate out in the market is today. Okay, so this was check number 776. And what is our debit going to be? Well, this time we'll have, same as last, we start with the carrying value for our interest expense. And that carrying value is $506,365.13. And then it's going to be times your effective interest rate, 0.062 or 6.2%, times a half a year, because this is semi-annual. So our interest expense, $15,697.32. All right, so how much are we paying actually? So we'll take our $500,000 times the 6.5% or 0.65 times half a year, $16,250 is our cash that we're actually paying. So we've got to have another debit here to equal it out, and that's our premium. We'll just subtract. $552.68 is our premium on bonds payable. So, not very complicated. I'm confident you guys can figure these out. Again, all your work togethers are in this workbook. You can hop on over to the other one to do your on your own problems. Good luck.